panel in the morning. We're going to talk about the status of LMI household finances. We're going to describe how important drivers of the overall economy are affecting the economic conditions facing American families. We will also discuss how the economic environment has created financial challenges for low and moderate income families and the financial institutions that serve them. This last recession, which began in December 2007 and officially ended in June of 2009, was the longest and deepest in our country's post-war history, 18 long months. For families, including low and moderate income households, the recession led to depleted assets, damaged credit scores, decreased geographic mobility, and lack of financial security. Before the end of the recession, job losses and decline in family income and net worth pushed the poverty rate to a 15-year high. While poverty rates rose for families across all racial and ethnic groups, historic disparities continued for African Americans, Hispanics, and to a lesser degree Asians relative to non-Hispanic whites. In 2009, the latest data available, there were close to 76 million families in the U.S. Roughly between 18 and 19 million families were of low or moderate income. With annual spending power of $1.5 trillion, LMI families make a substantial number of payments for food, shelter, clothing, and other necessities. And like any family, LMI households need a safe place to hold their earnings, a low-cost way to pay bills, an ability to gain access to their funds when needed, an opportunity to accumulate savings and build wealth, and access to reasonably priced credit. Certainly in the months and years ahead, Americans will remain focused on regaining their financial footing as a result of the downward slide caused by the recession. It's likely that this will be a particularly steep climb for lower income Americans. Our panel discussion today seeks to help inform the committee about the circumstances and conditions of LMI households and hear from you about your thoughts on the subject. We're quite fortunate to have two excellent speakers here today. Our first speaker is Rich Brown, our chief economist at the FDIC, who will provide us with an overview of the state of the overall economy as well as some of the important challenges ahead. And I'd like to welcome Keith Ernst, our new Associate Director for Consumer Research and Examination Support in the Division of Depositor and Consumer Protection. Keith is going to drill down a bit to provide a more intensive look at the financial and demographic conditions of LMI families. You have some slides in your packet that we're going to look at today.
All right, thank you, Ellen. Good morning, everyone. And the slide packet that Ellen is referring to is here. We'll refer to some of these as we move through. When I turn it over to Keith, he's going to talk more about the income statement and balance sheet of LMI households. I'm going to talk a little bit about what's developing as really a jobs crisis in this country that's contributing to hardship, I think, in this group. We have to think of the American economy as highly entrepreneurial, a job creator. From the 60s through the 90s, we saw between 17 million and 22 million jobs created every decade. But if you go back the last 11 years to the end of 1999, net job creation in the U.S. has been 500,000 jobs. In private sector jobs have declined by 1.1 million. It's only the increase of 1.6 million government jobs that has kept the number positive. And that's even after adding 768,000 jobs the first 4 months of this year. So this job creation engine has really slowed down in this decade. And where have the jobs gone? They've gone to globalization, they've gone to technology, they've gone to two recessions, including the most serious recession since the 1930s. That first chart at the top of page 1 looks a little bit about shifts in the composition of jobs. I mentioned the decline in private jobs and gain in government jobs. And of course, that makes things more difficult from a fiscal perspective. The fiscal pressure is part of that, where the tax base is not keeping up with the commitments of government. The shift in the private sector jobs, though, we've seen declines in higher paying sectors, manufacturing, construction. We've seen increases in some relatively lower paying sectors, education and health, leisure and hospitality. That decline of 5.6 million manufacturing jobs represents 1/3 of manufacturing jobs that existed at the end of 1999. So you see the severe effects that technology and globalization are having, as well as the recession on manufacturing workers. The second chart looks at income inequality, and we've seen an increase in inequality. This is a standard Lorenz curve that shows, if you look down at the bottom, you see that the lowest 20% of income, households with the lowest 20% of incomes right now earn 3.4% of total incomes. That's down from 4.3% in 1975. So their share is actually declining. The top 20% of households earn just over half of total income in the U.S. Now, how unequal is this? How does this compare to our history? How does this compare internationally? Economists calculate a Gini coefficient. It's essentially the area inside the bow over the entire area below the diagonal line. Our Gini coefficient is 45 right now. Well, how does that compare to other industrialized countries? Well, it's higher than Europe. The EU is about 30.5. UK is 34, Japan's 38, China's 42, we're at 45. It's about where it was, it's higher than it was in the 1970s. It was in the high 30s to around 40 then. It's gotten more unequal. And the last time it's been this high was in 1929, ironically. So I was sort of back to where we were before the Great Depression. So the transition to the knowledge economy is one of the factors driving this. Lower skilled workers having a particularly hard time in this jobs crisis that we're having. If you move to the second page, we'll look a little bit about the effects of the Great Recession itself. The U.S. economy lost 8.75 million jobs in the recession. Only about 20% of those have been recovered so far, even with the gains we've seen in the first 4 months of this year. And you look at this chart, and you see 7.8 million people have been out of work for 15 weeks or more. 3/4 of them have been out of work 27 weeks or more. And this is really unprecedented in our history, this long-term joblessness. Now, we've seen more jobless recoveries. The last 3 recoveries, we've seen more long-term unemployment as it goes away from cyclical layoffs to structural jobs being outsourced, done away with. And there's a growing body of research looking at these long-term dislocations. What effect does it have socially? And we see the research is quite striking. Displaced workers suffer large declines in earnings that persist for well more than a decade after the jobless event. It has effects far beyond the workers themselves. It has effects, even their rates of mortality are higher persistently for years after the jobless event. It has effects on their families. The educational achievement of children suffers in a statistically meaningful way after jobless events. The earnings of those children years later also is lower after a jobless event. So we know that the longer people stay unemployed, the harder it is for them to reattach to the labor force. This is particularly a problem for young workers just starting out. They don't climb the skill ladder that they need to when they can't join the labor force upon graduating from high school or college. So this high long-term unemployment that we see is going to have repercussions socially for years to come, and it keeps us below our potential. It makes all of our other problems worse in terms of the fiscal problem, the more demand for social services, lower tax base, and it's going to have economic repercussions for years to come. Also affected our other life cycle progressions. Household formation, for example. In the middle of the last decade, it was running about 1.3 million new households per year. That's consistent with overall demographic trends. It has slowed down dramatically in the recession. In the year ending in March, 357,000 new households. So you see a lot more doubling up, a lot more intergenerational households. And, you know, on one hand, economists say, well, this is pent-up demand for housing. Once they want their kids to move out, they'll demand housing, and it will help bring us back to equilibrium. But the longer it persists, the more likely it is that it will be sort of a long-term demographic shift. And again, interrupting the normal processes of household formation that drive demand in real estate markets. Another thing that's making it difficult for our labor market transition is the lack of geographic mobility. About 1/4 of U.S. houses are underwater. People owe more than the house is worth. So you see a pretty large decline in the mobility of households, making it more difficult for them to move to where the jobs actually exist. Among homeowners between 2008 and 2009, the mobility of homeowners dropped from 6.1% moved in a given year to 4.2%. So it dropped by about 1/3 as houses went underwater. So you sort of get an idea of the effect that the underwater problem has on mobility. And I would add also, before I turn it over to Keith, that the skills mismatch is another area in our labor markets. We see demand for high-skilled labor. In some cases, we don't see the supply of that high-skilled labor, at least in the same markets, making it, again, more difficult to match up demand and supply in the labor market, making for a long-term transitional issue. One more before I turn it over, and that is retirement insecurity and delays. And there's one more chart showing the decline in household net worth at the bottom of page 2. Between home price declines, rising indebtedness, and decline in stock portfolios, U.S. households lost $16.8 trillion in net worth, 26% of their net worth from peak to trough during the recession. They've gained back, or at least through the first quarter of this year, about $8.1 trillion. I would say that the declines in net worth were pretty democratically shared because a lot of people own homes, and it wasn't just stock prices as it was in the .com, it was home prices as well. The gains that we've seen have been more in the stock market and haven't been in the housing market. I think we've erased some of those in recent days in the second quarter anyway. So that's leading people to want to have to work longer, to seek to stay in the labor force. But again, we're not generating the jobs really to support that kind of labor market transition. So with that, I'll turn it over to Keith.
Great. Thank you. I want to acknowledge up front that Rich has provided a wealth of measurements and statistics, and apologize in advance for continuing to dump those measurements on you, but I think it's going to set the stage for the conversation, so I'll do it. I think one way to think about some of these developments, the changes in mobility, the retirement insecurity, is to look at the overall changes in assets held by households. Rich mentioned the 26% drop in aggregate U.S. household wealth, and those have been shared fairly equally. The median change for households was an 18% drop, and that's exactly the change in the lowest quintile or the lowest 20% by income in the population. In fact, that quintile now has a new net worth of $7,000. Looking through a slightly different lens, looking through at the lowest quartile, the lowest 25% by wealth, they saw a median net worth drop from $1,700 to $1,000, and the second quartile median drop from $13,000 or by $13,000 to $48,000. Along with the jobs picture Rich described, this median shift suggests there are many more families with LMI-type needs today than there were 4 years ago. Looking to components of net worth, first we see household asset values are down sharply. From 2007 to 2009, the median value of financial holdings dropped by 5%, but the non-financial holdings, those more likely to be held by low and moderate income families, dropped 14%, so a significant difference there. 27% of low-income homeowners report their home is worth less today than when they bought it. And the fifth chart shows part of the reason. Foreclosure rates in LMI areas increased from just under 1% in 2005 to 7% by 2009. In non-LMI areas, the foreclosure rate increased from 0.5% to just over 4%. So some significant differences there. For their part, home ownership rates are dropping across the board. For African Americans, home ownership rates have dropped 10% from their peak earlier this decade. For Hispanics, it's been a 6.6% drop. These are in contrast to the white non-Hispanic population, which has seen a 2.8% drop in home ownership, and the overall population, which has seen a 4% drop. The sixth chart in your handout shows that even among those LMI households not experiencing foreclosure, there have been deep effects. The biggest drops in prices of homes have been on the most modest homes. Those homes have dropped basically half in value, and that's in sharp contrast to the highest tier where we've seen a 29% drop. This trend held in all 16 cities for which this data source provides measurements. And while home values get a lot of attention, the most common asset held by low and moderate income households are actually automobiles. And what we've seen with automobiles across the board, across every income group, is that values are down around 30%. Car purchases seem to be being delayed as families struggle with the changes in the job market and think about how they're going to make ends meet. But as a result, maintenance costs are going up. And those are probably most pronounced for low and moderate income families. In the lowest income quintile, the median car value has dropped to $4,000. So you get a sense of some of those changes. Also on the asset side of the equation, long-term savings for low and moderate income families have decreased. 25% of low-income households have stopped making retirement contributions entirely versus just 16% in the general population. 14% of lower-income households withdrew funds from their retirement accounts early. As of 2010, 28% of Americans had a loan against their 401k funds, but in the income range of $20,000 to $40,000, 36% of women participants and 34% of men had taken a loan. Similarly, the story on debt for LMI families is distinct. Among the 15% of low-income households with a mortgage, housing debt has decreased slightly more than the general population. But on the other hand, while every other income group saw a drop in installment debt, the bottom quintile saw a 36% increase. Similarly, bucking the trend, the first and second income quintiles have seen an increase in credit card debt, even as credit card debt is down across the board and in aggregate. So some very different changes for these populations. Skipping ahead to the last chart. Skipping ahead to the last chart, we see that those with the lowest incomes have greater exposure to expenses that are more volatile or that consistently outpace overall inflation. In particular, food and health care are larger components of lower income household expenditures, 27% for the lower income households versus 19% for the higher income households. Other components like transportation are smaller as a share of expenditures, but given the relative fixed nature of those needs, they can become a much larger slice of the pie much more quickly for lower income households. I think the bottom line on this chart is that even stagnant real wages can make families feel less economically secure, particularly in the low and moderate income buckets. Despite and perhaps because of their economic challenges, low and moderate income families make substantial use of financial services. We've already identified differentiated use of credit cards and installment loans, and they're not restricted to LMI households. We estimate that alternative financial services used in this country totals at least $330 billion annually across a diverse array of offerings. For example, $90 billion was loaded onto prepaid debit and payroll cards in 2009. Sizing the population rather than the dollar volume, the FDIC has previously reported that 1 in 4 consumers are unbanked or underbanked. Fully 20% of lower income consumers are unbanked entirely. The needs of this population clearly go beyond transactions. For example, low and moderate income consumers express strong interest in savings. 44% say it's very important to save for general emergencies versus just 33% of the general population. Now, this presentation's had many sobering statistics. I think there are a few takeaways that can help frame the conversation. First, the dual challenges of long-term job loss and the housing crisis have taken a serious toll. Second, like other groups, lower-income households have lost wealth, though these setbacks may be more serious for families already facing significant challenges. Third, the population with low and moderate income type needs has grown substantially in this crisis. Finally, low and moderate income households have financial services needs and are finding ways to meet them now, albeit relatively expensive, through relatively expensive providers in many cases. Now, Rich and I are happy to answer questions, but I understand also that Ellen has some questions of her own for this group, questions designed to help explore the implications of these findings for banks seeking to serve LMI consumers today. Thank you.
Why don't we start by really opening it up to you, and then I'll interject as we go along, but I'd like to see if any of you have questions of Rich or Keith as we move forward. Wait.
Thank you, Ellen. Good morning. I'm Wade Henderson. I'm president of the Leadership Conference on Civil and Human Rights. First, let me congratulate you, Ellen, and the panelists. I think this was an extraordinarily helpful panel. And I think it was the most cogent presentation I've heard of the consequences of long-term unemployment on the fiscal status of the low and moderate income community and on the health of the country. And I think that your presentation should be made a required review process for those that are part of the economic team, both of the White House and who play that role on Capitol Hill. I have a couple of takeaways, and I want to just see if I can get your sense of whether I'm accurate in this respect. First, I thought your presentation reinforced a general view that the severity of this recession was deeper than anything that had been experienced previously, second only perhaps to the Great Depression of the late 20s and 30s, and that the consequences of recovery in terms of long-term unemployment, I mean, we have not penetrated effectively the creation of private sector jobs, in the way that most economists would normally have expected a recovery to occur. As a result, government has an important role to play in the job creation scenario, contrary to popular economic and political wisdom here in Washington. Government has a role to play. And I thought, Mr. Brown, your first chart, which underscored the fact that 1.1 million jobs have been lost since 1999, seems to belie the conventional sense that the private sector, once stimulated, will respond to this issue. And the tax cuts, which have been a virtual permanent feature of government policy, have not created the trickle-down growth in jobs that had been predicted. So there is also a need for additional revenues to help address the depth of this crisis, again, contrary to popular wisdom. And that means that taxes have to be on the table, just like everything else that's under discussion today in Washington. Thirdly, I take the view that the foreclosure crisis has been an exceptionally difficult issue for those low and moderate income communities, and the census tract data confirms that. And so when you take the severity of the foreclosure problem and juxtapose it to the difficulty in creating jobs, particularly in the low and moderate income communities where you've already established an educational threshold that is required to participate in the jobs of today, it seems to suggest that some level of government intervention in helping to transition between the current economic problem and perhaps a healthier economy is necessary. And so what that means, from my perspective, is that the government has a role in this foreclosure crisis beyond what it has undertaken so far. And without going too far afield, I would say that HAMP is not a program that unto itself is sufficient to address the problem. So I don't want to complicate the questions I've posed. Let me ask you to respond to some of that, and then perhaps I'll have a second round. Thanks.
Well, thanks for your comments. And I think that your observation that this has been the most severe downturn since the Great Depression by a wide range of measures is accurate in terms of percent job losses, in terms of lost output, in terms of the housing market repercussions. There's no question about that. The jobs engine being broken, then, there's a lot of causes for that. Small businesses create about 2/3 of new jobs. We look at the small business surveys. Well, what is the problem? Is it tight credit? And we know certainly that the financial system is not working the way that it's supposed to. We knew that in October of 2008 when these extraordinary programs of assistance were put out there. A seizing up of the financial system has huge effects on the real economy. We saw of those 8.75 million job losses, we saw about half of those in the 6 months immediately following the failure of Lehman Brothers. We saw the physical production of steel in this country, the volume declined by about half during that same period. So huge real economic effects. So I think it underscores that financial stability is absolutely essential to that jobs engine. But there are other factors as well. I think that the confidence of small business, their order books are not full. A lot of creditworthy small businesses are reportedly not seeking credit. They don't want to expand. They sense uncertainty. They sense some policy uncertainty. They sense weak demand. And I think there the global element plays into this. We see a lot of countries around the world whose economic strategy is to export their way to prosperity. Their policies are aimed at promoting that. But it's a closed world. Not every country can export their way to prosperity. And I think the coordination of policies across countries, I think it's become much more widely seen as a necessary challenge. We need to better coordinate policies across countries in order to shore up the job creation engine in some of the advanced countries, especially the U.S. So a lot of issues at play there. You mentioned housing as well. I think the home price numbers that came out this week underscore the fact that the things are not recovering in the housing markets. The foreclosure problems, the difficulty getting clear title, the slowdown in the foreclosure process, all these things have created uncertainty that have prevented investors to come back in. And I think we've seen that as a fundamental, as a factor holding back the broader economic recovery. So I think you put your finger right on the issue. It's been a huge dislocation for families, and it's a huge barrier to the type of recovery and confidence that we need to sustain the recovery.
And I would just add, I see your comments as touching on the qualitative nature of this recession in this economic period. And I think for households, and particularly for low and moderate income households, it's very pronounced and very, very different from other households that are going through this experience. I think part of what comes through in the data for me is that low and moderate income households aren't taking advantage of the opportunity to pay down debt. They're still assuming installment debt, credit card debt, even as households pare down. We hear about increases in the national savings rate, but among low and moderate income families, we see in fact that retirement savings are being curtailed. So some of the reactions you might expect families to take just aren't available to families that don't have enough income at the present time to follow those routes.
Thank you.
I would say, too, I think, the connection between what happened here and financial stability and some of the reforms we're trying to undertake now, particularly trying to get banks to deleverage other financial institutions, get capital levels up, is hugely important. And, I think just for insured banks alone, we saw loan balances drop by $800 or $900 billion, another $2.5 trillion in unused credit lines being pulled. I can only assume that really hit a lot of small businesses too, but it was the outcome of this tremendous deleveraging, and that was just the insured banks. The shadow sector, which was much highly leveraged, I mean that collapsed, and there was $1 trillion more in lost credit availability. So I think, I think everyone needs to think carefully about what's in our short-term and long-term interests, and I think there are a lot of arguments now being made by some in the financial services industry, not all, but some, that we can't raise capital because that's going to constrict lending. And my view is there's plenty of capacity to lend right now. Loans are not being made for combination. I think their borrower demand is down. I think there may be some undue risk aversion there as well. But we need to get this financial system on a more stable path, and we could get right back into the soup again if we don't continue the process of deleveraging, especially these very large institutions. So I do think, in terms of arguments that are made, and you'll probably hear them, and people will try to get you engaged, and imposing higher capital levels can constrict lending. And I would just say, first of all, I don't think the academic research shows that that's true. And second of all, I think we need to also view what is in our long-term interests, because the real economic impact of this deleveraging process has been quite severe.
Well, Madam Chair, allow me to respond briefly, and not to extend this discussion. I certainly understand the need to increase capital availability for the banking community. On the other hand, I think addressing problems in one sector without looking more broadly at the impact of or the change in regulations here on other aspects of the economy, I think in the end doesn't necessarily serve the national interest as well as the proposals are intended to do. Part of my concern is that the debate in Washington has taken off the table an important dimension of resolving the problem, which is to increase the availability of revenue to address long-term problems that are structural in nature and which everyone concedes are having an impact on the health of the economy. So when a senator, just being frank, I mean, when someone says, look, revenue enhancement, raising taxes is off the table, and yet everything else is on the table, then you create a problem that can't be resolved even with the effective regulation. So here's my only point, just to sum it up. If we still are an economy in which home ownership is the largest asset of most Americans within the middle class. And when you take the availability of access to that asset off the table by raising the margin of down payment necessary to get in the game, you obviously have an impact on some people who are in that low and moderate income group, particularly communities of color. Secondly, when you don't regulate banks and you allow those who were perpetrators of the current economic crisis to walk off scot-free, then what you have done, in effect, is created the very moral hazard that many have suggested would occur when you invest in government resources. And then thirdly, my only point is that, look, the foreclosure crisis had its greatest effect on low and moderate income households by the evidence here and by communities of color. And yet it was the only, you've seen the greatest shift in assets from communities of color that's ever been documented in modern times. And so the solution can't be to foreclose the participation of this community to an even greater degree in the home ownership, access to home ownership, which is the very basis of the asset and wealth development that we have in this country. It is a problem. So I certainly understand why my colleagues have raised real concerns about the solution that the White House has put on the table, because it doesn't serve all communities equally, and its impact has a disproportionately negative effect on communities of color.
Right, and I was just talking about increasing capital standard. I think, the broader, we've been very focused on this as well, and I think there is just from what I read, I agree with you. It doesn't seem like you can get a political consensus unless revenues are on the table. And there are a lot of conservative economists that are acknowledging that too, and I think there's especially interest in special interest tax expenditure, which is a good area to tackle, where you could pick up some significant revenue, particularly in the corporate tax code. If you got rid of all those, you could actually low corporate rates and still pick up a lot of money. So I think there is a good discussion along those lines, and I didn't mean to weigh into that debate but I do think on the issue of increasing bank capital requirements, there has been some effort to suggest that would constrict credit, and I would hope that